Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today, Mena, I would like to talk about the common mistakes that entrepreneurs make in the first 3 years of running their business. And whilst we're sort of focused on the first 3 years, because what we've done is sort of put our collective experience together, both personally, to be honest, I've made a lot of these mistakes myself over the years, but also the experience from dealing with our clients. And really just sort of asked ourselves, what are those common mistakes we see in the first 3 years? But even if you've been running your business for longer than this, it's always good just as a bit of a reminder and to sort of rehash on what your approach is, because sometimes we make these mistakes beyond the first 3 years. So what we've done is we've got a bunch of mistakes, about 9 of them, I think, and we're just going to talk about them in turn. They don't all relate to each other, but let's start off with the first one, Mena.
So the first and probably most easiest mistake that all entrepreneurs make is using their personal bank account for all business expenses. And this is a classic early stage mistake. And why it's really dangerous is because it's really impossible to track all income and expenses. And it makes, and I've got a personal interest here, your accountant or bookkeeper's life a nightmare. So it's really important to keep clear sort of bank accounts. So it helps you sort of track GST and tax compliance. It creates better habits for your cash flow, and it helps sort of keep record keeping in general a whole lot better. So what it also allows you to do is separate separate accounts for different purposes as well. So generally we recommend clients set up a separate sort of ATO or tax savings account where they can sort of provision for their GST, their PAYG, their super and so forth. And then we also recommend clients use a software such as Xero to automate the process, to make it a lot easier, and in reality also reduce your compliance costs with your accountant and bookkeeper. Because if you go give them your personal bank account, which has a whole bunch of personal expenditure in it, it's more likely to cost you more than actually separating it and using a software such as Xero.
Okay, the next mistake is no cash flow forecasting and giving consideration sort of to debt commitments. And I guess it goes hand in hand with the mistake that Mena just spoke about in terms of segregating your personal and business cash flow. So I guess the first thing to think about is that profit does not equal cash flow always, because profit gives us a measure of, what you've sold and what it cost you to deliver that product over a particular period. But whether you've been paid for those sales yet, whether you've had to pay for the input costs, whether it's staff salaries or raw materials or the actual product that you're selling, yet isn't reflected in the P&L. So cash flow is really the most important, and it's the lifeblood of a business. And as Mena spoke about, providing for taxation liabilities, GST, if you have to pay PAYG installments, as in installments on company tax in advance of lodging your tax return, all these sorts of things you need to understand. Also, when you're going to make business commitments, whether it's hiring another team member or buying a piece of plant and equipment or investing more in holding a greater amount of stock, these sorts of decisions, they're all critical cash flow decisions. So it's absolutely important, particularly in the first 3 years of business, to understand how your cash flow is going to change over the next 12 months and even sometimes beyond that, depending on the nature of the commitment that you're making. After 3 years in business, and the business starts to build a good cash flow buffer, and you start to better understand your business and your business's cash flow. And if you've made those earlier mistakes in terms of overcommitting, you've learnt your lessons a little bit. So I'm not saying that it stops becoming important, but I think it's just even more important to really understand your business cash flow and look at it probably every month, if not more often than that, and especially before you make any major commitments.
The next biggest mistake is not pricing properly or undercharging. Now, a lot of entrepreneurs, when they start, and sometimes I got to admit, we are guilty of it at times or early on, was that they charge too little. And the reason is you fear losing customers. You want to compete on price just so you can win the business, you can guarantee the revenue. And sometimes it's a form of imposter syndrome, really, because you're really undervaluing yourself. You're really basically saying, okay, I've got a business, I can generate the revenue, but I'm not really there yet. So I just got to compete on price just so I can get the business through the door. Now, it's not really a great outcome because you end up with no profit margin, no money to really invest in your support, your systems, your growth, or even at a personal level. And it creates a whole bunch of burnout because I'm sure everyone who starts a business doesn't want to be working for, say, $10 an hour. So what you got to do to fix it is to calculate what your minimum viable price is. Now, we've spoken about this previously on, I think it was episode 125 in the Holistic Accounting podcast, where we discussed how to price, how to sort of establish what margin you need to keep a viable business running. And then you can benchmark that price against your strong competitors. Don't price yourself against the cheap ones because the cheap ones might be a volume-based business rather than a business that provides quality or anything like that. And then you got to raise your prices annually. You got to forecast what CPI increments are. You got to look at, okay, your staffing costs never remain stagnant. Your staff typically, even if you're on an award rate, get adjusted every year by CPI. So it's really important to adjust your prices annually so that you can cover your costs. Because if you can't pay yourself properly, you don't really have a business, you just have a hobby.
Okay, the next mistake, and it's a bit of a contradictory point. The next mistake is trying to do everything yourself, but also not doing everything yourself. So, of course, that's a confusing statement, so I better explain myself. It's a really difficult balancing act when you're building a business because there's things that you do inside your business that you could pay someone to do on your behalf, and you could go and spend your time on more high value activities. That is, activities that are going to produce better outcomes, whether it's growing the business or growing the productive nature of your business or training staff, doing all this marketing, doing all these sorts of things. And if you work out, okay, how much value can I create by doing that divided by the number of hours that you spend doing it, that is your hourly rate. And logic tells us that you shouldn't do anything that's worth less than your hourly rate. You're better off to pay someone, $30 an hour to do some bookkeeping, for example, rather than do it yourself. The flip side to that argument, though, is that you want to run a lean business and you want to minimize expenses as much as possible, particularly in the early years, to give your business the best chance of surviving, if not thriving, over that period of time. And so preserving cash flow, preserving cash flow in terms of minimizing expenses or maximizing the amount of cash that stays in your business is going to make a stronger business. So you can then invest that cash towards further growth and strengthening your overall business. So that's why I say it's a balancing act, because both are right. Both ideas are right in that you should be focusing on those high value activities, not getting sucked into your business and doing these, I'm going to call them sort of menial tasks. It's probably not the best description, but tasks that, that you either aren't fantastic at, or you can pay someone a relatively low cost to do them for yourself, versus trying to minimize all outflows, trying to minimize all expenses. And so the mistakes, I think, happen at the extremes. So the extremes is trying to do absolutely everything yourself and not delegating anything. Surely there's something that you can delegate to someone that's going to be more cost effective, even if it's a virtual assistant or something like that. It doesn't have to be a permanent one, can be a part-time. And the other end of the spectrum is delegating absolutely everything. It comes down to a really good example I can give you is marketing consultants. It's difficult. I'm not saying they're all not going to add value, but at the beginning of your business, they can be really expensive. And ultimately, your business and where you want to take your business better than what someone else does. You don't necessarily know marketing better, but you've got, with AI and so forth, you've got so much exposure. So I think that those sorts of things where, you're probably better off to do it yourself because you're going to have to learn that process and that insight at some point anyway, rather than delegating absolutely everything. So it is a balancing act, but that's at the extremes is where we see the mistakes.
The next mistake is where entrepreneurs don't set clear financial targets for themselves. They're too sort of involved in their business, in the daily operations, that they don't set sort of things such as revenue goals or profit targets or KPIs or benchmarks for the business. And as we always say, you've probably heard us say it 1,000 times in this podcast if you're a regular listener, that you can't manage what you don't measure. So what ends up happening is you just drift. What you got to do is set yourself clear gross profit goals, net profit margin targets, revenue per employee. Actually understand what the cost of your employees and what their output is, what your cash targets are, and what what cash you need to actually invest in the business. What we typically advise people starting out in business to do is to set 2 to 3 core numbers that they need to measure monthly. And sometimes you can even, if you're using a product such as Zero, even set these up on your dashboard so that it's there at the forefront of everything that you do. And that way you've got a clear understanding of your business and the key drivers or metrics that actually are related to the success of your business.
The next mistake I want to talk about is not knowing your numbers. And look, it's absolutely critical to know your numbers, and it's good to get into the habit of understanding and forcing your understanding. Now, people that start a business at the beginning obviously don't necessarily come to it with a very robust understanding of how businesses work, how to read P&L statements, how the accounting system and process works, all those sorts of things. So it's a massive learning curve, and there's so much to learn at the beginning. It's just one additional thing. And so quite often people think, well, I'll just delegate that to my accountant. And that's absolutely true. But what you can't delegate is knowing your own numbers, knowing, what your profit margins are, what your cash flow looks like, where your break even point is, which products are the most profitable products. So you still might have some products at very low margin if they're used as a way to acquire customers, but you want to understand what that product mix is, lifetime value of a customer acquisition costs. So how much, marketing spend does it cost you to add an additional customer into your business, how your balance sheet's working, all these sorts of things, they're really important. And I think it's also important in the beginning to run a lean business. As I said previously, sometimes spending money on the wrong things can be a real problem as well. And that can be insidious, right? Because there's a lot of transactions in a business. And so sometimes it can be a lot of little transactions and they tend to add up. But unless you're sort of taking that helicopter view and looking at the grand totals, they're hard to sort of pick up. So running your eye over the P&L every month, understanding where your profitability is and where your expenses are, and asking yourself, how can I run this business a little bit leaner without destroying customer quality or product quality, I should say, or service quality, of course, but where can I enjoy those savings? And as I said, it builds a good long-term habit of really understanding those numbers and getting into the habit of looking at them regularly and studying them and working out, what does this tell me and what action should I take as a result of this new information?
Lastly, the next mistake is not thinking about the long-term structure of your business. Now, most people start their business as a sole trader, and it's generally recommended to do so, until you sort of understand your sort of business and, the revenue and targets and so forth and how profitable it's actually going to be. So it could be the right structure for a short period, but problems can arise when you start to earn more, or if you need to hire staff, or if you're taking on additional risk or trying to build wealth. So it's really important to understand these metrics because it can lead to things such as not having appropriate asset protection or sort of paying more tax than what you really need to because you're in a sole trader structure and you're at the top marginal rate as an example. Or there's no ability to income split if you've got a partner or a family. And also is a hindrance when it comes to succession planning. So you really need to ensure that you review your structure at least every 6 months. Is it still the appropriate structure? And it needs to be with a long-term view. Now, a lot of people get put off with the fact that the setup of companies and trusts and so forth can be costly, as well as the ongoing compliance can be costly. But the way I'll frame it to my clients is that it's a sort of like a one-off insurance cost. You need to ensure that the structure's right and it will pay dividends for you in the future by the fact that you can retain profits and pay tax at the corporate tax rate of 25%, as an example, might give you the flexibility to distribute profits to your partner, to your family, who might be at lower marginal tax rates. So it pays off for itself. So it's really important to review it annually and to ensure that it's a structure that's built to allow you to grow, not just for today, but for your future. Your business structure becomes your wealth building engine. So you need to choose it intentionally.
Okay, a bit of a negative episode this week. All those mistakes. There's a lot of mistakes there, of course. And I guess it's no surprise that a lot of small businesses fail. The old statistic that 80% fail in the first 5 years and only 20% of those survive a decade. Part of it's a survivorship bias. People make decisions to wind up businesses or sell businesses for different reasons. But I think the failure rate is high. So just to recap, the mistakes were, separating personal personal and business cash flow and expenses and bank accounts, making sure you have a understanding of forecasting what your cash flow, not profitability, but cash flow looks like, particularly if you're going to make large commitments, whether it's buying equipment or hiring staff. Pricing, something we've spoken about on the podcast a few times, getting that right, positioning yourself, making sure that, that your gross margin's adequate enough for a sustainable business, trying to balance between doing everything versus doing nothing. I don't know if doing nothing's the right answer, but, finding that balance, setting some really clear financial targets, making sure you really understand your numbers, and make sure that you have a coherent long-term structure that's going to, as Mena says, allow you to build personal wealth using your business. So they're the most common mistakes we see. Hopefully through this podcast, we can help you avoid them, both by educating you on all these aspects, but also as a regular reminder as well. So until next week, bye for now.